Okay, hello everybody. This podcast is going to be a little different today, in that, as you can see or you can hear, Brent is not here. Brent had a previous engagement that he couldn't get away from. Well, it actually came up today, but an engagement that he couldn't get away from today. So it's just me on the podcast. So I'll keep it relatively short. I'm going to go over two main points. First being what we've been dealing with for the past 6-8 months is inflation. I know y'all are probably tired of hearing us talk about this, but it's the number one driver of the market right now, and it's not going away anytime soon. So, we're going to keep everyone abreast on, what's going on with inflation. So today, the CPI, or consumer price index, came out, and it was it was high. So it's been high every year for the past 6 months, but today it was the highest. The past 6 months has been anywhere from 7 to 8%. This month's broke 9%. So inflation relative to where it was a year ago, for the month of June a year ago, is up 9.1%. So we've seen almost a 10% rise in prices over the last year. 10%. That is unheard of. Remember, inflation is typically 2 to 3%, right? So we're almost 5 times typical inflation right now. The market didn't like it. The market tanked initially. It kind of, for a day where inflation came in the highest it's been for the last 8 months, being up 9%. The market actually digested it pretty well. I expected the market to implode, be down 2, 3, 4%. It didn't. I think the market ended at about 1%, which was surprising. Bond yields, so what happens is things like this happen. People sell stocks and go into bonds for that safety. And when people buy bonds, interest rates typically drop on bonds. So today rates didn't drop as much, which means a lot of people didn't sell their stocks and jump right into bonds for that safety. So it was a little bit of a curious trade. I'm not exactly sure why it wasn't. The market didn't react worse. My thought is that the market actually expected a worse number. They probably expected to be worse than 9.1%. So the 9.1% came in relatively okay for the market. So that's part of the bad news. The other side of the bad news is that so the Federal Reserve last month raised interest rates 0.75% or 75 basis points. That is historically high. After today's CPI print, the thought is now they're going to raise actually a full 1%, and I think the next rate hike is either next week or the week after. So, but it's this month. So interest rates will be going up considerably higher, possibly a full 1% this month. Don't know if it's going to happen, but right now the market is kind of pricing that in, a 1% hike. Whereas just last week, the likelihood of that was like 5%. Now the likelihood of that, the market is betting, is about 75%. So rates could be going up considerably higher this month. And on top of that, so there's no meeting in August. So in September, there's thought that they would then go back. If they do a 1% this month, they'll go back to 75 basis points or 0.75% in September. Or if they do 0.75% this month, 75 basis points, thought is that they may do 75 basis points again in September. So all that means rates are going higher. That is not good for stocks in the short term. We're going to continue to see crazy volatility. And today's print was bad. I mean, the CPI number today was just horrible. And it shows that inflation is nowhere near under control. The rates that the Fed has done so far, only place they've really showed, well, two places. They showed up in commodity prices. So things like oil, gold, and then agriculture, corn, wheat, things like that, copper. A lot of those have come down. The other places it's shown up is in housing. So the rate that the houses were being bought before, way down, because interest rates now are approaching 6% for mortgage rates. So we've seen the effects of what the Fed are doing are having some effect, but they're not having the effect. So where it was worse this time around, relative to last year, the biggest portion were rents. Rent prices are still going through the roof, and the reason for that is home prices are the rates on mortgages now are so high that people that were thinking about buying are continuing to rent, or either continuing rent, or people are, instead of buying, they're just deciding to rent. So there's a huge competition right now for rents. So rents are up considerably. So That's the bad news. Really, rates up are going to be going a lot higher. The Fed wanted to target their what's called their Fed funds rates, or basically rate every other interest rate is set off of. By the end of the year, they wanted that to be about 3.4%. After today's prints, that may push 4%, which means, remember, all of the rates are based on that. That's like the baseline for most rates. So any variable rate is going to be going considerably higher this year and into next year. So like Brent and I've been saying, if you have debt that you can pay it down ASAP. Those credit cards, any variable rate debt that you have, because rates are debt is getting, the cost of money is going up exponentially almost at this point. The way this, because inflation is just not coming under control yet. So that was the big news of today. That's kind of the depressing part. So I want to end on kind of a, okay, what should you do? What should you do part? So some news came out a couple of days ago that electric vehicles, or EVs, are now 5% of all cars that are bought in the United States. Now, put that in perspective, in 2020, I believe it was, the auto market in the United States was 1.2 trillion with a T, 1.2 trillion. So that shows you the huge amount of runway there is for EVs. The thought of the industry, the car industry, is that once the industry hits about 5% on any particular vehicle, now being EVs, that it's reached a threshold of mass adoption. So they're saying going forward now, EVs will become a bigger and bigger slice of the automotive market. So what does that mean for us as investors? That means that looking at anything related to EVs, the Teslas, the Rivians, what have you. Now, granted, those are down big, and they're probably continue to go down big, or at least not go up very much, because again, the whole inflation, Federal Reserve thing. But as far as looking out 3, 5, 10 years, EVs are a gigantic opportunity. EVs, batteries that go into EVs and charging stations are just huge opportunities, because again, remember, it was a $1.2 trillion market in 2020. That's going to rise every year, give or take a few percentage points. So there's a huge opportunity for EVs going forward. So definitely look into EV stocks. Not saying get into them now. Everything right now tech related is risky. But if you can dollar cost average slowly, small percentages, maybe a few dollars every month into EV makers, that's a good trade. Potentially good trade. Another information out of EVs was that, I don't know if anyone's heard of a company called Canoo, but they're an EV maker, and Walmart ordered 4,500 of their EV vans that they're going to use for local delivery, for kind of like what Amazon does. But you see the Amazon trucks. Soon you'll start seeing Walmart vans or trucks. And Walmart ordered 4,500 vans from this EV maker called Canoo, named Canoo. I forget their ticker symbol, but just look up Canoo. It's spelled CANOO. You should be able to get their ticker symbol. They are public. The stock is like, well, it was like $2, $3. But on the back of the news from Walmart, it was up 100% a day or two ago. So I think it's around $4, $4 or $5 now. So that, look up Canoo. So look up Canoo as a potential. Remember, do your own research. But EVs are a huge market opportunity. Canoo is one that's seeing some adoption. Big company like Walmart is now adopting their vans for the delivery. So that's my, since I'm here by myself, that's my that'll be my stock of the day. And usually we don't put that out there, but it's only me. So we usually only do one for the Facebook group, then two inside of our membership platform, but it's only me. So pick today for myself is Canoo. So definitely look into that. And so that's pretty much it. But again, the main story of the day, inflation is still running red hot, 9.1% up year over year for the month of June. The Federal Reserve is now proposing, they're considering a full 1% rate hike this month, which again will be historic. If you have any debt, any variable debts, try to pay them down. Rates are going considerably higher. And this is going to be an ugly market. I said earlier this year that I from what I believe in, like January, February, that second half of the year would probably potentially be good. And I said a few weeks ago, I don't believe that's the case anymore. And I still don't believe that's the case, especially after today's CPI print. The Fed is just going to stay uber aggressive. They're going to continue to raise rates fast and furious, and that's going to keep pressures on stock in the short term. Now, long term, this is all good, because what it's going to do is going to bring the economy. It's going to get all the fluff out of the economy that we've had the last 2 years and get us back into a typical market, a typical economy like we had in 2018, 19, and even early 20 before the pandemic hit. So long term, this is all good. It'll weed out a lot of the weak companies. It'll weed out a lot of the weak hands. But in the short term, it hurts all of us. It's very painful. But we're here to bring this information to you so you know what's going on, what to expect, and just expect more volatility. Expect much higher rates coming, which is going to affect all of us. But again, remember, the rates are going higher. The reason the Fed is doing this is to slow down inflation. We haven't really seen it that much yet, but it's going to. Like I said, we've seen it in pockets of the economy. It's going to hit the broader economy sooner or later, more probably by the end of the year. But this is a good thing in the long term. It's just really painful now. So that's all I have for today. We'll catch you all. Brent will be back next week, and he handles all the recordings of our podcast. That's why I'm doing it myself here today. But catch everyone next week, next Wednesday at 9 o'clock, like usual. See y'all then.